Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Monday, March 31st. The stock market closed the first quarter on a winning note, but alas, today's gains weren't enough to avoid yet another month of declines. The end result is that the S&P 500 extended its losing streak to 5 consecutive months, the longest such streak since 1990. Monday's outing was accented by a handful of developments, the most prominent of which was a proposal put forth by Treasury Secretary Paulson to enact a sweeping overhaul of the U.S. financial regulation system. Paulson's plan, among other things, calls for a much larger oversight role for the Federal Reserve, the merging of the Securities Exchange Commission with the Commodity Futures Trading Commission, a federal charter for insurance companies, and the closure of the Office of Thrift Supervision. The main thrust of Paulson's proposal is to streamline bureaucracy in the regulatory system. The plan, which had its roots last spring, was not intended to be a response to the current crisis in the financial markets. The plan itself provided some provocative talking points, yet the realization that it wasn't going to be implemented anytime soon, if at all, diminished its impact on today's market. The latter point notwithstanding, the attempt to modernize the regulatory process and make the U.S. financial system more competitive in the global marketplace did not go unappreciated. The financial sector, rebounding from last week's losses, played a supportive role that enabled the broader market to overcome substantive declines in S&P components Merck and Schering-Plough. Those stocks declined 15% and 26% respectively after the efficacy of cholesterol-lowering drugs Votorin and Zetia was questioned by a panel of cardiologists who recommended prescribing the drugs only as a last resort. Other supportive influences in Monday's trade included a decline in oil prices and a better-than-expected regional manufacturing report. Specifically, oil prices, which touched 106.78 early in the day, fell 3.7% to 101.74, while the Chicago Purchasing Managers Index checked in at 48.2 versus the market's expectation for a reading of 46. A number below 50 still connotes contraction, so bullish enthusiasm was held in check. Tuesday, the market will be provided some insight on national manufacturing activity in the form of the March ISM Index. Economists expect the survey to reveal an overall reading of 47.5 versus 48.3 in February. Briefing.com looks for a slightly higher reading of 48. Until then, investors will be left to contemplate overnight the worst quarterly performance for the market, in which the S&P 500 declined 9.9% since 2002. Separately, the Dow Jones Industrial Average dropped 7.6%, the NASDAQ Composite declined 14.1%, the S&P 400 Mid-Cap Index slipped 9.2%, and the Russell 2000 fell 10.2%. I'm Pat O'Hare for Briefing.com. Thanks for listening, and have a good evening.